Peak Wealth Management proudly presents the Trust the Plan podcast with Nick Hopwood and Jim Pilat, where we believe by providing education and guidance, we can help you retire with peak confidence. Now, here are your certified financial planners, Nick and Jim.
Welcome everyone to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And this is week 3 of the Ohio State review game. But first, Jim, before we get into the football, let's talk about holiday plans. What's going on?
Yeah, Christmas is coming, huh? It's
get the tree up and everything, and all the presents under the tree.
Yeah.
Stockings.
Yeah, looking forward to all that, but also just having the family home again. It's interesting, over Thanksgiving, my daughter, who's in her freshman year of college, we hadn't seen her in, a dozen weeks or so. So it was nice to have her home for a good stretch. So we'll be looking forward to that at Christmas as well.
She sleeps till like 1 p.m. every day.
She didn't. Apparently I learned that my bedtime at home is earlier than hers at college. So when I said, "Hey, it's 11, shouldn't we go to bed?" She looked at me like, "It's only 11."
Yeah. Like, isn't the bedtime in college minimum midnight?
Yeah, I think you must be starting at midnight.
Yeah, I think it is. For me, it was. I think. But I have a senior in high school who's home over the breaks as well, and he sleeps till like 1.
Yeah.
I'm like, what are you doing? It's wild.
Yeah.
Okay, Jim. So it's holiday season. It's fun and exciting, and the markets have been pretty good too.
2 years in a row.
Yeah. So shockingly good. Okay. So when we found this from Ryan Dietrich on Twitter X, our buddy Ryan, he's an Ohio State fan, by the way. I should actually reach out to him.
Yeah, I'm sure he'd appreciate that.
He does. He does usually when I talk to him about it. So anyway, when the S&P is up 20% 2 years in a row, he says it isn't a reason to be bearish. But, doesn't the pendulum usually overswing, right? Isn't it getting a little stretched right now?
I think that's why this is a good topic, because I think that's what most people think. Anytime something's gone up for a couple of years in a row or prices seem high, everybody says, I'm going to wait for it to come back down. I'm going to wait for it to come back down. They say that in the stock market, obviously, but how many years have we been hearing that in the housing market, right? Houses are up. I'm going to wait for them to come down, and everybody wants to wait for it to come down.
Yeah, you could be waiting a while, right?
You definitely can.
So here's what this chart, here's how we interpret this chart. Assuming that December, the bottom's not going to fall out. December's usually a good month, right? Especially in the election year when it's already been a good year. It's usually good. And there's another chart that we can find from Ryan that shows that, but it's less interesting. So in this chart, we want to say this has happened 8 times. This year would be, or this edition would be the 9th time. But up until now, it's happened 8 times. And then the question is, what happens in the 3rd year? Right? And that's the 3rd column here. Okay? In the 3rd year. And 6 times out of 8, it's been a better market with the average return of 12%. Okay? So looking at it here on the surface, the 3rd year, after all the strength, is usually a good year. So, if the pendulum is swinging, it's continuing to swing in the same direction, and that rubber band is really getting stretched, right?
Yeah.
And so when I also look at this, there's 2 other things that I want to talk about. The first is that 4 of these times was in the 90s when we had the internet bubble. So we got 95, 96, 97, 98. So that was a 5-year stretch. 95, 96, 97, 98, 99, where every single year was over 20%. Okay, remarkable year stretch. But then that led to what?
The tech bubble. It burst eventually.
Yeah. So we're here saying the bubble can get bigger and bigger and bigger year after year, which is not a good thing. Okay, so 4 out of those 8. 1, 2, 3, 4. 4 out of those 8 was the internet bubble. So let's examine the 4 years before that. So 1950, 1954, 1975, 1982. In these cases, the returns in the third year were, 18, 7, -7, +6. That's not a 12% average, right? That's like a 6% average, right?
Right.
So actually, that's even worse, I think. So it's a, positive 3 out of 4 times, but nothing great. Okay. In the internet bubble, positive 4 out of 5 times with exceptional returns. And then also what's misleading, in my opinion, is right here, the year 2000 being -9. And really that year was wild because the first 3 months were straight up. Remember, the bubble burst in March of 2000. So the first few months straight up, and then the crash began. So the fact that the S&P was only -9 in that year is a little misleading because what happened next was 22, which was down like 30%. Okay. And then 23, the first quarter again was a disaster.
02 and 03.
Yeah, sorry. 02 was a disaster. 03, the first quarter was a disaster. So from March of 2000 to March of 03, you lost over 50%.
Yeah.
Okay. And so it was a nightmare. Okay. That's when I started my career. I got licensed in 2000. Okay. I was an intern in 99. I remember that bubble all too well. I was a little too late for it though. I mean, I was a little too late for the ramp, for the ramp up.
Lead up.
I was there. I was in the front row for the full crash though. So, does this mean that the third year is going to be good or bad? I don't know. Okay. The fact that half of these examples are the bubble really scares me. But, the other times, not so scary, right? So it's a really small sample size. And so right now the economy is doing pretty good, and we'll have to see.
Yeah, I mean, that's right. There's a business-friendly administration. There's interest rates should be coming down. There's reasons that it could continue. But like you said, it's hard to know where you're at in the pendulum, if we use that pendulum example. To me, it all leads back to this is why we want to build diversified, well-rounded, all-weather type portfolios. It's easy to look at, these kind of years and say, what are we doing? We got to get in. We got to participate in those big years. We want to participate in them, but, to put all your eggs in one basket and attach to those hot growth stocks, at the wrong time, it can be really painful to own those.
Yeah, absolutely right. And when it comes in, when we're coming into a market that's bad, and I'm not saying that's happening right now, but we always want to think about risk and make sure that we're not taking too much risk because after the fact, it's too late to adjust. Okay, so always be thinking about, even in the good times, what's my exposure? How much money do I have in stocks? And then and realize, when do I need this money? So if we need this money next year, I want it to be safe. If we don't need it for 10 years, then we can be more aggressive, okay? Because, we have a bear market the last couple of years, and then it's over, and then we rebound.
Yeah.
But if we need the money now, this chart should be meaningless, right? Because that money needs to be safe. So always think about it with in terms of risk. And then we can also say, hey, look, a lot of markets are not participating, right? The value has not participated as much as growth. Small caps, not as much as the S&Ps. And international emerging markets, not nearly as much as the S&P. So there's areas in the market which, if we do have, the S&P rollover, there's areas that maybe offer more value, perhaps. Not a recommendation, not advice, but just talking it through. And I will say in closing, in 2000, 2001, 2002, if you can compare like the Dow and the S&P and NASDAQ, we all know that NASDAQ did the worst, right? The NASDAQ index was down like 90% because a lot of the companies just went out of business. Whereas the S&P went down, in the low 50%, like 53%, for instance. The Dow, I don't remember exactly what it was, but it was much less than the S&P. Why? Because it's made up of companies that were not tech. So while NASDAQ was going to the moon in March of 2000, the Dow was just kind of bumbling along because it was like ketchup companies, and valued companies, industrials,
grocery stores.
Yeah. And now there are more tech names in the Dow, but the point was back then the Dow was actually a good place to be because it didn't blow up like the NASDAQ did.
Yeah, definitely.
Okay, so if you want to talk about Michigan, Ohio State, if you want to talk about the market here coming into next year and how it relates to your portfolio, maybe you're looking for a second opinion with what you're doing, you want to talk to new advisors, give us a call, reach out to us at peakwm.com.
Peak Wealth Management thanks you for watching and listening to the Trust the Plan podcast, featuring certified financial planners Nick Hopwood and Jim Pilat. If you enjoyed our program, please subscribe and share. If you'd like to learn more about our services, please visit peakwm.com. peakwm.com today. See you next week.